in the middle to the late 90s when I started out. Okay, uh, borrowing to finance anything was still the exception rather than what used to be an art has now got transformed into a science.
70% of iPhones, if you see, that was bought in 2023 was bought on EMI. And 1 in 4 products bought on Amazon is also on EMI.
The gold in India is high. We have the world's largest stock of privately held gold. So we will continue to grow at least a 25%.
Hi everyone, today we are in Mumbai with Fed Financial Services. It's a subsidiary of the Federal Bank and it's a 4,500 crore market cap company. And to discuss about the company, about the industry and where this industry is heading, we have with us the Managing Director, Mr. Anil Kothuri. Hi sir, nice to be here. Thank you very much. So firstly, I want to get started with how was your journey before joining Fed Financial Services?
So it's actually Fedbank Financial Services. I'm a computer engineer. I studied in Andhra University between 88 and 92. After that, I pursued my management education at IIM Ahmedabad for 2 years. And 94, I joined Citibank.
Okay.
So it's now 30 years that I've been working, and 28 of those 30 years have been in consumer lending.
Okay.
So within Citibank, I was involved with mortgage loans, unsecured loans, share finance. I ran an auto loan company. It was called Citicorp Maruti Finance Limited.
Okay.
And in my last stint there, I ran the SME business.
Okay.
It was called City Business. In 2010, I joined the Edelweiss Group, where I helped set up and scale up the retail lending vertical for that company. So we had an HFC and an NBFC, and we scaled to an AUM of about 11,000 crores.
Okay.
That was till 2018. And in 2018, I joined Fedfina, and at that point in time, we had a retail AUM of about 1,000 crore rupees, which is now 12,000 crores as of March 24. So in a nutshell, that's been my journey over the past 36 years. Yeah.
Wonderful. So this AUM you mean is the money that you've lent out?
That's right. AUM stands for assets under management.
Okay.
Okay, that's all the money that we've lent out, which customers owe us.
Okay.
The AUM has two components. Okay, one component is what you have on the books of Fedfina.
Okay.
There's another component of loans that you would have sold down through direct assignment or securitization transaction, or you would have done co-lending.
Okay.
So all of that is money that's managed by you, customer outstanding that's managed by Fedfina. Even though some of it could have been downsold to other lending entities.
Got it. So you mentioned that you started your journey in early 2000s in this space. How has the environment changed compared to today versus back then?
Retail lending was quite nascent in the middle to the late 90s when I started out. Okay, borrowing to finance anything was still the exception rather than the norm.
Okay.
So to give you an example, loan against property was just about starting out in the late 90s. The industry AUM would have been up 1,000 crores, say, in 98. That is now about 7 lakh crores. So that has been the kind of growth that we've seen, and this is proxy for all other retail lending products that were there. Now lending was still boutique, it was still exotic.
Right.
Now it has got a lot more standardized. Those days we didn't have a credit bureau. Now the bureau is fairly standard. Bank statements were all on paper, so there was the possibility of forgery and things like that. Now bank statements are available through PDFs, and you have account aggregators and stuff. Collateral was largely paper. Okay, and now you have electronic collateral. Lien marking is electronic. So lending has gotten a lot safer from a lender's perspective, and the market has actually improved. So what used to be an art has now got transformed into a science. Okay, and you have tools like analytics and stuff that you can use to make better credit decisions, and manage your portfolios better.
So art into science. That's a nice
right.
way to put it. And you said about the past, everything was on paper, it was not formalized. Now you got a credit bureau, things are more formal, it's easy for you to screen clients while giving money to them, and hence the cost of credit, meaning the interest rate they have to pay, comes down because your risk is lower compared
Correct.
to back in those days, right? Now, where do you see this industry heading? Because what I mean is 70% of iPhones, if you see, that was bought in 2023 was bought on EMI. And 1 in 4 products bought on Amazon is also on EMI. So where do you see this industry heading? Can I say this industry is in slight of a bubble, or is it that the base is so low that we are getting frightened because of the percentage growth that we see?
Look, when you start off on a small base, the percentages will always look high. Okay, but the important thing to see is that in terms of evolution of the economy and the penetration of credit in our country, we are still far behind when it comes to far more advanced economies. Okay, China is bigger than us, Thailand, whichever other country you see, the penetration of retail credit as a percentage of GDP is far higher. Okay, so what we are doing is really catching up with the rest of the world. The second way to look at it is to look at the credit per capita.
Okay.
Now, whichever lending company there is, they follow some prudent lending norms when it comes to giving out credit. They very often look at the customer's income, his ability to repay, and the income can be assessed either through direct means like his salary slip and P&L, or through indirect means by looking at spending patterns and stuff. So there is a method behind how you underwrite a customer. Okay, so while the growth has been strong, the per capita borrowing is still quite meager, and you look at it that way, then I think we are on reasonably safe ground.
No, that's the perspective I wanted to get from you, and so I want to come later to how you screen customers, especially people who do not have credit score. But before that, I want to understand your business in very simple terms. You take money, you give money. This is what a bank, NBFC, at the end of the day do. So, can you explain firstly, where do you acquire money from, where do you take money from, and which segments of the population do you lend it out to?
Sure. So Fedfina's mission is to empower emerging India with easy access to loans.
Okay.
So that's our mission statement. Emerging India refers to the small self-employed customer. Now the small self-employed customer finds loans very difficult to get. He does his business using his own equity, or there are some community networks which he can draw on for informal debt. Okay, so to offer him formal finance is to empower him to conduct his affairs at a far higher level of efficiency. Okay, so that's what we aspire to do. Now, working capital solutions to the customer, to the small self-employed customer, we provide that in 3 different ways. This is through pledge of gold, through mortgage of property, or unsecured.
Okay.
So these are our primary businesses. Okay, so that's what we do. Now, on the liability side, we get our money from banks, mutual funds, development finance institutions, and so on. So that's in a nutshell how our business works. Yeah.
Wonderful. So to summarize, you get money from financial institutions, mutual funds, and you give it out to self-employed, because look, even the PMO, even the government is very gung-ho about promoting entrepreneurship, because that will eventually create employment. So you're trying to tackle that piece of problem where these self-employed people, even if they want to grow, but they don't have sufficient working capital. So by the pledge of gold, pledge of property, and some unsecured, you're giving money to them.
That's right. Yeah.
Got it. And I want to break it up. So there are different financial institutions. First, behemoth is banks, HDFC, SBI, etc., etc. Then there are shadow banks, that is called NBFC, and Fedbank, Fedfina Financial Services is one of these NBFCs. And from my understanding, banks, they are regulated more tightly, and they can take deposits that people want to withdraw within 12 months. So below 12-month tenure deposits they can take from customers. But NBFC on the other side, you're less tightly regulated compared to banks. And secondly, you cannot take deposits which people need before 12 months, right? And in NBFC, if there are, let's say, 95 commercial banks in India, NBFC, there are 9,300 NBFCs. And from my understanding, there are 3 to 4 tiers, and you are placed in the mid tier. So if you can quickly, in very simple terms, explain like the tiers or which tier you belong to.
Sure. So a bank branch offers assets, liabilities, everything. NBFCs by and large only offer assets to the customers. There are very few deposit taking NBFCs, and the RBI has stopped giving out deposit taking NBFC licenses. They used to be at peak about 16,000 or so NBFCs, which have been getting whittled down since 2013 onwards or so. So that has been the trajectory of this. On the regulatory front, there has been greater harmonization of regulations between banks and NBFCs. Okay, and the Reserve Bank is keen to curb what they call as regulatory arbitrage. That that NBFCs do something which banks can't, and so on.
Okay.
So that's one of the ways the Reserve Bank has been dealing with this. Now, for regulations and governance, the Reserve Bank has split NBFCs into three tiers: upper tier, upper layer, middle layer, and base layer. Okay. Upper layer is if you have an AUM of 50,000 crores plus. So below that is the middle layer, and the base layer I think is less than 1,000 crores or something. That is just how the Reserve Bank has wrapped their arms around the issue of regulating NBFCs. Okay, so that's the way it is.
Awesome.
So in terms of regulations, the regulations are there. We get audited every year. So the audit process and the regulations are reasonably stringent, and NBFCs go through pretty much, or the middle layer and upper layer NBFCs go through pretty much the same audit process as a bank does.
Okay. Yeah. So I'll take a slight detour. I want to speak more about the industry. Before that, I want to speak about the company too. So you did your IPO in which year?
This was November 23. We got listed in November 23.
November 23. So your first even financial statement, financial report has not even been released, and it's a new listing, right?
Actually, we've declared our quarterly results. So Q2, Q3, Q4, 3 quarterly results have got declared. But yes, the first annual report will come out shortly. Yeah.
Great. And so when I see from 2018 to 2024, there has been tremendous growth. I'm not just talking about in terms of AUM, the money that you're lending plus the asset on the books, but even in terms of profitability. So how did you scale up from 2018 to, and especially I'll speak about what happened in 2018, all these things, but 2018 was a very difficult time. And from there you scaled up quite tremendously. Your balance sheet, everything checks out well. So how were you able to do that?
Yes, some liability side events did happen in 2018. But however, that's where some of the advantages that Fedfina has came to play. First up, we are a subsidiary of a private bank. Okay, so we have good pedigree, and lenders find it comfortable to lend to us.
Okay.
So while other NBFCs found it difficult to raise money, Fedfina didn't have that problem. The second thing is that some organizations closed down. They were going through some turmoil, and all that talent found a safe home within Fedfina. Okay. So, and the third thing was that because of the various issues, there was a certain gap in the marketplace, which we were able to plug in. But that was timing. So what we did was to hire a lot of people, expand our branch network. We had 500 people then. Now we have close to 4,500 people. We had 120 branches. We now have 620 or so branches. Okay, and we put out our suite of products, some of which didn't exist pre 2018. So we put that out, and we began to grow from there on. Yeah.
Okay.
So good thing about our country is that the opportunity is immense, and the segment that we are serving is hugely underserved. Okay, so with the advantages that I've described and the attractive marketplace that we cater to, we've been able to grow over the past 6 years. Yeah.
No, industry itself has been growing very well, especially because of regulations compared to other countries. In the US, if you see, we had a slight debt crisis, banks going bust, but India has been tremendous in that manner. And so then, like, let's say next, you've spoken about this. What is the risk that you see? Because especially in financial institutions, there's a lot of risk involved. So what are the risks that you see, let's say 2 years on, 3 years on?
Sure. There are two kinds of risks. One kind of risk is, execution risk.
Okay.
Where you lend to the wrong customer, he doesn't pay, or you make mistakes on the liability side or stuff like that. But that, through experience, whether it's Fedfina or any other lending entity, people have learned to manage. There are established principles and guidelines on how to manage this. The risk that one needs to worry about and ponder about is these one-off events that keep happening. The same event doesn't happen a second time. So really it boils down to your resilience as a company and a management as to how you tackle this. Now let's see what has happened. 2016 there was demonetization. 2017 there was GST, which impacted a lot of customers. 2018 was the ILFS crisis. 2020 was COVID-1. 21 was COVID-2. So all of these things have been hitting one after the other and posing different challenges to managements. So it really depends on how you deal with each crisis and how you deal with it. So we don't know what's going to happen in future. It's an extremely interconnected world and and an extremely volatile kind of an environment. So we just need to learn to deal with the unknown unknowns that periodically keep popping up.
Absolutely. So that means a lot of risk management is involved. When it comes to risk management, lending to the right people and avoiding the wrong parties, let's say, in a very blunt way. So how do you screen? For example, less than 5% people have credit cards. People do not even have credit scores, and you're saying you're catering to the self-employed segment.
Correct.
So I'm sure a lot of people do not have credit scores yet. They're just starting off, getting into the financial fabric, etc. So how do you screen customers and maintain and ensure that the defaults are low? How do you do that?
Okay. Sure, there are the self-employed customer, like we discussed, uses his own money to do business. So he welcomes any access to debt. The second point is that the self-employed customer is a borrower for life. So it's not as if he ever does business using his own capital, he will always have debt. So for that, maintaining a good track record for debt is important. People understand bureau, people understand the importance of maintaining a good track record. Now, the question then boils down to how do you assess the individual's income when he doesn't have paper to evidence his financial stature?
Yes.
Okay. So we do that through a process of interacting with the customer and assessing his turnover and income. Let me just give you an example. One of our customers sells egg-based snacks in Ahmedabad, bananda and omelette and things like that.
Okay.
Now, our credit manager spent an evening with him. Okay. We saw what his turnover is through the course of the evening. So on that basis, you know what his monthly turnover is. So you look at what his input costs are, egg and oil and bread and stuff. There's a couple of helper boys that he pays. So you know what his surplus is. Okay. Now, you try and see if he's got this surplus, then how much can he use to comfortably repay the loan. Okay. You also ask the question, what has he done with the same surplus last year?
Right.
Okay. So people typically either buy property or gold or some financial instrument or repay debt, there's a wedding, something happens. So you try and take proof of that. Separately, you try and reconfirm this through some data points. So for instance, if he sells so many snacks, he also has a godown where he stores his eggs.
Okay.
So you visually inspect the godown, confirm that he has a certain inventory of eggs.
Okay.
You also talk to his suppliers and figure out what his monthly purchase of eggs are. So that's how you know that his turnover and his income, that you're assessing is done in a reasonable fashion.
Okay.
So that's the way you do this. Yeah.
No, so this is a tedious process, right? To analyze a customer thoroughly before giving out the loan. Okay. Now, what if someone is yet to start a business? They're looking for working capital. I don't know if you encourage those customers, but in that case, what would it be? Currently, they do not have a shop. They are just wanting to start off. So how do you access there?
So what we do is we lend to customers with an established track record. Okay. Because our premise is that we have a standardized method of underwriting and we do it very quickly and we do it in a cost-effective fashion and in a way that works for our customers. Okay. So we all of this requires the customer or the prospect to have a track record.
Okay. Yeah. Okay. And so we now coming into another segment, which is gold loan. Because you have the big collateral, which is highly liquid, unlike a property, let's say, the the measures that you'll be taking is slightly lower, right? And there's a larger part of the population you'll be catering to. If you can correct me if I'm wrong.
Yes.
In terms of gold loan, and somewhere you said that except for South, like other regions, especially Kerala, other regions, the penetration of people pledging their gold for liquidity is low. So, why do you think this pledge percentage would increase? Like people say usually, because West is doing well, West is like 10x better, so we should eventually, even our size would increase. Is it because you're looking at the West, or do you just generally feel that 7% figure is very low in terms of gold loan?
So the attachment to gold in India is high. We have the world's largest stock of privately held gold.
Right.
Now, historically, South India has been pledging gold for bridging working capital requirement, emergency borrowing and stuff. So, and it has taken shape through organized lending, and there have been players in place for several decades now. Okay. Now, North India, West India, Eastern India, also people pledge gold, but the networks are still informal. Okay. So formal gold finance is relatively new ex South India. Okay. Now, whatever has happened in South India in terms of penetration of gold loan branches, the organized delivery of lending against gold, okay, all of this is ready to happen in the rest of India. Okay. Now, people's mindsets are also changing. Okay, they see gold, and for them, gold is like any other investment. 25 years ago, borrowing against property was for working capital was not too common, but now it's fairly mainstream. Okay, the same thing is happening with gold. People are seeking to realize the emotional benefits of having a gold ornament, along with the financial benefits of that. So it's not a dead investment anymore. You can borrow against it for working capital, to balance your cash flows, whatever, and do it. So they're just getting more out of their assets, and that's the mindset that's taking root.
Absolutely. And now, like gold prices are near all-time high. So how does that impact your business? Because at the end of the day, you're giving loan based on the value of the collateral, right? So firstly, can you quickly tell me what percentage do you give out? Let's say gold is worth 1,000 rupees. How much of loan will you give out?
Yeah, the regulations say that we can lend up to 75% of the value of the gold. Okay. So our average LTVs tend to be around the 70% mark. Loan to value ratios tend to be around the 70% mark.
Okay.
So that's how the gold business works. And as the price goes up or down, the amount of money we are willing to lend to the customer also goes up or down.
Absolutely. Got it. Now, you said 75%. That's a good question of good 25%. But what if we've seen this with gold? It is a inflationary hedge asset, but at the same time, there have been a lot of fluctuations in the price of gold. For example, if you take 2011 to 2015, it fell by 36% from the top to the bottom, and then in 2020 to 2021, it fell by 22% from top to bottom. So during these times, what do you do? Because you have that gold in place and you've given out, let's say, 1,000 rupee gold, you've given out 750 rupees, but now that gold value has come to 800 rupees as such. So what do you do in that circumstances?
Okay. One feature of gold loan is that it is a short tenor loan.
Okay.
The customer typically pays up between 4 and 5 months. Okay, so that's the time that he holds this. Now, during that period, the price of gold could correct 5%, 7%, and the 75% LTV that we do, and there is cushion for interest and stuff. That's the way it works. Now, we are not worried about whether the price of gold goes up or down. It is only the pace of change, okay, that matters from a risk management standpoint. And gold is not a volatile commodity where the price falls, let's say 15% or 10% in the course of the day. So it's a far more stable kind of a thing. So that is really what works for our risk management.
Is that why no one is doing silver lending?
Well, people tend to buy gold as opposed to silver. That's just the way it is. Yeah,
absolutely. And so that is gold loan. Then yes, lending to self-employed. Is there any other segment that you are looking into, or in maybe next 5 years that you consider, okay, we'll go into this segment, or is it too early to say?
The products that we have, gold loans, mortgage loans, and unsecured loans, cover about 2/3 of all lending, consumer lending in the country. So I don't think we'll start anything new because within this product there's ample scope for growth. Okay, we may open a few branches in places that we are not currently represented, but what we are doing is good enough to give us growth for the foreseeable future.
Okay, got it. And so in the next 5 years, what would be your priorities? Like you said, you do not want to go into many new segments, like you rightly just said. So next 5 years, what is your target? You just want to grow this existing business because you had said previously that it's very underpenetrated. There's a huge scope for growth. So is it like double down and just expand this market, increase the AUM?
Absolutely. So we will continue to grow at least a 25% compounded annually.
Okay.
So that really should be achievable given the products that we have and the people that we have. We will open branches, like I said, in places where we don't have branches, and we will pretty much continue to do the same thing.
Okay.
We will hopefully do it a little better and reap the advantages of scale,
Yeah.
and which should lead to greater profitability of the company. But yeah, that's it.
From what you just said, I have two sub-segment questions. Firstly, you said branches. If I take UK, which is a very developed economy, from in 1986 they used to have 20,000 branches. Now in 2024 they have 5,000 bank branches. That includes HSBC, Barclays, Lloyds, etc., etc. In India, on the flip side, the number of branches for banks, NBFCs is increasing. Like you said, that we have done tremendous growth in number of branches. Like you're opening 12 per quarter types. So what is the difference? Because some areas where we want to look at, we say West is here, so we should get there. But West is, in this case, the West is going another direction, we are going another direction. So why is there a difference in terms of number of branches?
2 points here. The first is you should compare the countries at their respective stages of development.
Okay.
Now, the UK is at a certain stage of development, and people used to go to branches for transactions. Now, with the spread of the internet and mobile and the ability to access things digitally, the need to go to those branches has diminished. Okay. So, which is the reason branches have come down there. Now, India, the penetration of bank branches itself was low. Okay, so which is why it was increasing. Specific to Fedfina, we have two kinds of branches: mortgage loan branches and gold loan branches. We necessarily need to have a gold loan branch because the customer comes in and gives us gold. So there's a vault there where we store the gold and stuff. So we necessarily need a branch wherever we do our business. Now, mortgage loans, now it's a branch where the employees sit, interact with customers and stuff. We have roughly one every district headquarters in that we are present in. Okay. And if we open another state or another district, there will be one branch there. So that is the way branches work for us.
If you were to open a branch today, how many years or months does it take to achieve profitability? Because you had mentioned that average AUM per branch is like 8.5 crores. So how much time does it take for that branch to excel?
So for a gold loan branch, it takes roughly 15 months to break even.
Okay.
And for a mortgage loan branch, we break even by the 9th month or so. These are approximate kind of numbers.
Okay.
Yeah.
So look, break even, let's understand. If I'm looking at a chemical company, it is revenues minus the cost of that chemicals. That is the profit, meaning you add all the other subline items. But in terms of banking, it would be the amount that you've got as interest minus the amount that you have paid as interest to the while you borrow, and then you deduct the expenses like your employee expense, your fixed because branch expense, the rent that you're paying. That is your net income, right?
Correct.
Okay.
Absolutely. So it's what you said, and if that number is greater than 0, you've broken even.
Yeah, exactly. So you're taking it per branch and saying, okay,
That's
we'll
right.
take break even in 15 months time.
Yes.
If it's a gold business branch. Got it. And now, because we touched upon financials, look, for in very layman perspective, if I look at other industries, let's say it's very easy. Let's say if I look at infra company, market cap to order book ratio, like order book to revenue ratio, like how many projects are like not happening because of land acquisition issues, etc., etc. In banking and NBFC space, it's a lot of different ratios, NNPA, GNPA. So can you please help me identify top 4 ratios that you consider? while looking at any company, anything, or your own company, is it like top 4 ratios you prioritize? And can you give me like a two-liner or one-liner or what this ratio is, or if higher the better, or lower the better?
Sure. The most important thing is your return on equity,
Okay.
which is basically how much money you're earning for your investment in the company. Obviously, the higher the better, and our aspiration is to have a late teens return on equity.
Okay.
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 Now, adjunct to this is a return on assets. Okay, so which is basically your profit divided by your assets. Okay, so that is the second number. The third number, which talks about the quality of the portfolio, is the GNPA, level of GNPAs. Okay, GNPA, NNPA, credit cost, these are different ratios
Okay.
that you look at to determine the quality of the
Sorry,
portfolio.
what is GNPA?
Gross net performing assets.
Okay.
NNPA is net non-performing assets.
Yes.
Okay. The difference between the two is how much money you set aside
Uh-huh.
as provision for these loans.
Okay.
Okay, so that's basically what it is. That tells you something about the quality of the portfolio.
Got it.
And finally, you measure the quality of the operation through cost to income ratios. Obviously, the lower your cost to income, the more profitable you are.
Okay. So according to you, return on asset, ROA, return on equity, ROE, NNPA, net non-performing asset, and then the cost to income.
That's right.
So ROA, high the better, ROE, high the better, NNPA, lower the better, right?
Yes.
Because you have to set aside less. Okay. And third is cost to income. So lesser the cost will be better. So lesser
That's
the
right.
better. Got it. Now, so now some of these items you played very smart. So first two you had identified profit like growth kind of ratios, and the other two are like risk type of ratios, right? Because lower the better. Now I want to hang on to the risk element. Now, in 2018, what we saw was that this infrastructure leasing and financial service company, IL and FS, many people know about it. Everyone who's been in the market since, let's say, 2015 also know about this event. I think what happened was this company defaulted on a 450 crore debt, and then what happened was the stock market saw a correction, and the funding towards NBFCs, like people, like institutions, were not comfortable lending to NBFCs, and because of that, the interest rate on if NBFCs were to avail credit, the interest rate went higher. Because of that, couple of NBFCs went bust. And then that followed. So NBFCs were not able to get credit, and that affected an economy or the markets. And mutual funds were not comfortable because you had earlier said that mutual funds invest in us. So mutual funds weren't comfortable holding NBFC debt, and even a lot of mutual funds holding these NBFC debt closed down. Their fund scheme had closed down. For example, I think it was Franklin Templeton that closed down 6 debt funds of theirs. So during this very difficult event, from what I understand, I might be wrong, this was as severe as, let's say, 2009 crisis. Can you go through like how did you weather this? Because you were a federal bank subsidiary, did that tremendously help? And then how were you able to recover from that? Because I want to understand your risk management over there.
So actually, this actually played to our advantage.
Yes.
The reason for this is that we are a sub of Federal Bank, a majority sub of Federal Bank. And I'll tell you exactly what happened at that time. I think sometime in the last week of September is when all this started. Okay, we need to raise some money. Okay, and we actually got inbound calls from large mutual funds asking us whether we will take their money, because in their mind, lending to Fedfina was far lower risk than lending to another company just because of pedigree.
All right.
So that time it actually worked to our advantage, and we actually managed to borrow and scale up our book from, I think, 1,000 to 2,000 crores in that course of that year or so.
Okay.
Yeah.
Okay, so that was an opportunity rather than a...
Yes, that's what normally happens. What happens is in good times, people tend to take greater risk. Okay, or in their mind pursue avenues which are higher risk. In bad times, there's a flight to safety. Yeah.
Understood. No, that's a wonderful concept that you've explained. And so now you've spoken about the different segments. We spoke about the industry. Now on the risk side, RBI has stepped in because RBI understands that the personal lending, meaning people taking personal loans, have increased. Because personally, as like anyone in my office or me, I get at least one call asking for personal loan, this loan, that loan, by several different banks, by the way. And this trend has increased. And RBI recently came out and said that the risk weightage we're giving to personal unsecured consumer lending, meaning personal lending, but I'm not putting a collateral.
Yes.
The weight on that, and weight on banks lending to NBFCs, the credits that is going to NBFCs. So basically, if you're taking money from bank, whether it's Federal Bank or HDFC Bank, whatever, that it's more difficult now. So how is that impacting you right now? And do you expect the margins to slightly thin, because your net interest margins to slightly thin because of this?
There are 2 points that you made here. The first one is about risk weights on unsecured loans for consumption.
Yeah.
We don't do unsecured loans for consumption.
Right.
We do only working capital loans, which are outside the purview of the RBI circular. So
Okay.
that regulation doesn't impact us at all. Now, the second point was about RBI's, about banks lending to NBFCs. Risk weightages for that have gone up.
Yeah.
Okay. Now, as a consequence, they need to set aside a greater amount of capital for whatever they lend to NBFCs. And even if they want to make the same return on capital, they'll need to price loans a little higher.
Okay.
Now, this event happened in November, but in December and January, we've got rating upgrades from our 2 rating agencies. We are now rated AA plus. So that has been a countervailing kind of event, compensating event for us. So our cost of borrowing hasn't changed significantly, because I think one of these events have cancelled out the other. Yeah.
So I don't know if you are able to say this, but if you're allowed to say this, what is your cost? Because you had mentioned the term cost of funding. How much is it? And cost of lending? Not sorry, the rate that at which you lend. How much is it in terms of percentage?
Sure, that's all part of our investor deck. I can talk about it. We borrow at between 8.7 and 8.8%. That's our average cost of borrowing, and the weighted average yield on our portfolio is upwards of 15%.
Wow. Okay. Now, so a very out of the box question, because you're 8.8%. I got an like home loan. They're offering an 8.5%. So how do NBFCs getting money at 8.8% offer at 8.5%? It's a very candid question from my side.
No, the NBFC that gets money at 8.8 will not offer it to you, obviously at 8.5. It's a bank that will give it to you at 8.5. Okay. And an NBFC caters to a different segment. So obviously they need to make a certain reasonable spread on the money that they borrow. Absolutely. So it's a different organization, really.
Okay. Yeah. So NBFCs will be borrowing at a slightly higher rate. Banks will be borrowing at a lower rate, so that they're able to provide home financing at.
Yeah. So the banks have access to CASA, current account, savings account money. They don't pay any interest on current accounts. On savings account, it's about 3.5%. So therefore, their average cost of funds tends to be a lot lower, which is why their lending rates are lower. But for that, they lend to customers of slightly superior credit profile. So that's the game.
Okay. No, so that makes much sense. This was a very genuine question that I had when you spoke about it. Now, my last question towards the end. What is the biggest threat, or because your duty as a managing director is to foresee threats, foresee opportunities, and minimize the risk and maximize the opportunity, right? So what is the risk that you see in the medium term, let's say 1-2 years? What is the biggest risk that you are foreseeing?
So we spoke about it as the risk of the unknown. Yeah. So that is really what tests you, because you can never be prepared for something that you don't know about. Okay, and that really is the biggest thing, because all other trends that you see, okay, whether it's the move to digitization, you can foresee credit trends. Cost of credit will go up or down. Interest rates are going up or down. So there are leading indicators which tell you what the future is going to look like. So if you have a view on the future, you will also prepare for it. Okay, and if you prepare for it, you will also deal with the future a lot better. Now, it is events that you can't foresee, which will catch you off guard, and the strength and resilience of your business model and your management gets tested in such a scenario. That really, the risk of the unknown is
always there.
That's always there, and that's what we need to worry about.
Absolutely, that's for every business.
Absolutely, yeah.
And every sector has its own good days and the bad days. Whether it's infrastructure, Infrastructure back in 2008, 2009 was a difficult time. For banking, it was 2018 was a difficult time. Chemical 2021, 2023 was a difficult time. So this keeps sector specific. Absolutely. So it was wonderful having this short chat with you, and just a wonderful conversation. Thank you very much, sir. Very
Thanks so
insightful.
much. All the best. Thank
Thank
you.
you, sir. All the best.